Hi, Hari this side. So one of the most favorite candlestick patterns or the candlestick that we actually like to use in order to trade breakouts is none other than the inverted hammer. Okay. So today like we personally had a trade on crude oil at 5067. So the logic is pretty simple. If you have a look at it, so I'll just quickly show you the chart of crude, the US oil. Okay, so let's have a look at the charts of US oil because that is what we actually follow to trade. Okay, so in this particular case, I'm using the 15 minutes time frame, and you can see after some sort of a pretty good bullish side move from the afternoon today, we saw the price actually holding somewhere around the 5070 marks, 5070 Indian rupee or 69.4 US dollar. Okay, so for a pretty good duration of time, the price halted over here, and we also understand that this is a particular point from where earlier also the price had faced rejection. That is, crude oil was actually kind of finding a rejection from this particular region earlier too. So based on the same thing, and we see inverted hammer getting formed over here. The next 15 minutes candle is conveying to us, yeah, this is actually a bearish candle. Now the advantage in these kind of candles is that usually the risk reward ratios would be pretty much great. So for example, from afternoon onwards, we saw such a good bullish side move. Now, if the price is actually to face a rejection from this point, there is sufficient space for the price to actually drop down. And in fact, we see, okay, if the price is to drop down easily, it can find a support over here. So this could be the next level. And pretty easily, you could capture something like a 1 is to 2 or even a 1 is to 3 and 1 is to 4 if the price continues to move on the downside further. Okay. So our setup was our trade was actually kind of pretty simple. So we actually kind of got started by shorting crude at 5067 marks. So these were the levels where we shorted crude, and initially our stop loss were at 5083. Okay, so initially the stop loss was at 5083 with our entries at 5067 marks. In fact, this was the second trade in crude today. The first trade was a long side position. So this was the kind of price that we actually witnessed. This was the kind of combinations that we were actually seeing at the time of entry. So 5067 was the shorting price. So 5083 was where the stop loss was kept. Now, gradually, as price started dropping, so gradually as price basically started dropping down, so the next part, what we did is we trailed down our stop loss. So initially, if the stop was over here at 5083, we trailed down the stop to 5060 marks. Okay, 5060 marks. And in this particular trade, the risk taken was around 16 points. So the risk was around 16 points, the distance between the entry and stop loss. So more or less, your 2R or double the risk is like a 32 points. So we trailed it down to 5060, and within another 5-10 minutes, some a pretty good favorable fall in favor of our direction took place, and we took out some partial exits. Okay, so at the average exit price is around 5038.5. That is like 1.8 times of whatever we have risked. So in this particular video, I would like to conclude by saying, okay, so this particular inverted hammer, just like any other pattern, is not going to give you some amazing. I don't expect you to get some 100% or 80% or even 75% accuracy in these kind of setups. So in fact, from my personal thing, when I trade in crude oil, when I check out for these kind of rejections coming from some significant supply zones, my hit rate is actually in the range of 40 to 50%. That is, if I perform 10 trades, this is like 4 or 5 trades that ends up winning. But what matters out over here is that if you're capable of being in the right side of the trade, you'll be able to capture some decent moves. Now, other thing is, if the price moves against you, okay, you lose 1 hour, but if it moves in favor of your direction, you could capture something like a 2 hour. Now, there could be even some cases when the price more or less stays consolidating at this particular range where you shorted. So then you can actually realize for yourself, okay, now it could be a potential time for you to come out of the trade. Why? Because okay, crude is actually has been in some sort of an uptrend, and you took a counter position based on the rejection. So price is consolidating, and let's say you're looking at some other confluences like RSI divergence, or you're having a look at the opaque data. Okay, so you must be knowing about the inventory data, all these things. So if it is on some day like that, okay, so confluences are once again on the bullish side, you can exit out the trade. However, if you're in the right direction of the trade, you could catch up something like a 2 hour easily. And in fact, somebody who would be trading rejections, the good thing that they would love is you can actually capture some pretty favorable risk to reward ratios in these kind of rejection trades. Thank you.